Welcome to CoreLogic's update on housing market conditions for May 2017, brought to you by Smartline Personal Mortgage Advisors. The latest set of housing market indices showed a cooling in the rate of capital gain during April, with CoreLogic's combined capitals index slowing from growth of around 1.2% per month over the first quarter to just 0.1% over the month of April. While the result demonstrates a stark slowdown in the pace of capital gains, we need to remember this is just 1 month of data, so it will be important to monitor the data flows to see if this recent softening develops into a sustained trend of cooling housing market conditions. If the coming months do show a similar soft to negative result, it's likely to be a firm indication that the housing market is moving through the peak of what's been a very strong and sustained cycle of growth. The soft April reading was mostly due to a slowdown in the performance of the hottest markets. Sydney dwelling values were unchanged in April, and Melbourne returned a gain of just 0.5%. Both cities showed remarkably flatter results than what we've seen over recent months. While the softer results hint at a slowdown in the housing market, other indicators are also suggesting April may have been a slower month for housing. Transaction volumes fell in April, however this can at least partially be attributed to seasonal factors like Easter, the school holidays and the Anzac Day long weekend. Transactions were also lower than at the same period a year ago, across most regions. Another factor that can help to explain low transaction numbers is a slowdown in mortgage-related activity. CoreLogic valuation platforms recorded the lowest number of events per working day since July last year. Considering CoreLogic platforms account for more than 95% of banking sector valuation instructions, the activity that flows across them provides virtually a real-time indicator about mortgage demand. The slowdown in mortgage-related activity could also be partially seasonal, which is why we look at an activity-based measure that's on the number of working days in a month. But there's also the fact that mortgage rates have been rising since August last year. According to the latest RBA data, the average discounted variable mortgage rate for investor loans has shifted 25 basis points higher since August last year, which is the equivalent to a typical RBA rate hike. The 3-year fixed rate for investor loans is now 30 basis points higher, and discounted variable rates for owner-occupiers have also shifted 10 basis points higher since August. With household debt levels at record highs, it makes sense that households will be more sensitive to the cost of debt. For investors, this sensitivity is compounded by the fact that rental yields are at record lows in Sydney and Melbourne and have trended lower across the other capital cities as well. On top of rising mortgage rates, at the end of March 2017, APRA announced further macro-prudential measures which mandated that banks couldn't originate more than 30% of new mortgages on interest-only terms. This new policy setting is likely to have the effect of pushing mortgage rates higher despite a stable cash rate and acting as a further disincentive for investors participating in the housing market. A slowdown in investment activity will inherently impact those markets where investors are more active than others. Specifically, these measures are likely to dampen demand in the Sydney market, where the latest data shows investors comprise 57% of new mortgage demand across New South Wales, and Melbourne, where investors comprise 46% of new mortgage demand across the state of Victoria. Let's take a look at housing market conditions across each of the capital cities. The Sydney housing market took a breather in April from what's been a dramatic growth run over the past 5 years. Dwelling values were virtually unchanged over the month, recording a monthly movement of negative 0.4%. Sydney house values did stage a slight rise over the month, which pushed the quarterly growth rate to 4.5%. However, unit values were 1.2% lower over the month. Up until recently, the pace of capital gains has been relatively even across Sydney's house and unit sector. However, a recently stronger performance in the detached housing sector has pushed house values 17.4% higher over the past 12 months, compared with a 9.8% rise in unit values. Potentially, the increase in unit supply is starting to weigh down the rate of capital gains in this sector, a trend that's very much become embedded across the Melbourne and Brisbane housing markets. Melbourne's market saw a further rise in dwelling values over the month of April, rising by 0.5% over the month to be 15.3% higher over the past 12 months. A substantial gap has opened up between the performance of houses and units, with house values now 16.5% higher over the year, while unit values are only up by 4.1%. One of the more interesting developments in the Melbourne housing market has been a rebound in weekly rents. Rents are now rising at just over 4% per annum across both the house and unit sector. With capital gains across the unit sector now below 4% per annum, there's actually been a slight improvement in the gross yield for Melbourne units, rising from 4% to 4.1% over April. While the yield may have shifted a bit higher, yields in Melbourne remain close to record lows. Brisbane's housing trend remains similar to previous months, with mild growth recorded across Brisbane houses, while the unit values slipped lower. House values have been rising by only 2.6% over the past 12 months across Brisbane, while unit values have actually fallen by 3.1%. The weaker conditions in the unit sector can at least partially be attributed to concerns around high supply levels across key regions of the inner city. However, the weakness in the unit sector appears to be more broadly spread across Brisbane, which may suggest that buyer sentiment has been negatively impacted by these supply concerns. Rental market conditions have remained subdued, with the median rental rate holding virtually steady for houses over the past year and falling by 2.3% over the year for units. Despite the relatively weak rental sector, rental yields across Brisbane are substantially higher than what can be found in Sydney and Melbourne. Adelaide dwelling values moved a notch higher in April, rising by 0.8% over the month to be 2.2% higher over the year. The subtle growth conditions are mostly confined to the detached housing sector, where values have edged 2.4% higher over the past 12 months, while unit values have slipped by 0.2% over the year. Despite the soft rate of capital gain, market activity has trended higher across Adelaide. CoreLogic has recorded 8,690 settled sales over the first 4 months of the year. That's 3.6% higher than the same period a year ago. If buyer demand continues to improve across the Adelaide market, it should translate into improved growth conditions. Perth's housing market has defied predictions that values were starting to level out, with dwelling values down 2.2% over the first 4 months of 2017. The market's been working through a correction since December 2014, and since that time, dwelling values have decreased by 10%. Interestingly, the number of settled sales over the year to date is tracking 4.3% higher than the same time a year ago, suggesting that buyers may be starting to take advantage of the strong buying conditions that are evident across Perth. While stock levels remain well above long-term average levels, there has been a reduction in the number of properties being advertised for sale during 2017, which should help to restore some balance between buyers and sellers. Hobart dwelling values remained on the upswing through April, rising a further 1% over the month to be 6.6% higher over the year to date and 13.6% higher over the past 12 months. The annual change in dwelling values is now the third highest of any capital city, which is quite the reversal of fortunes for the southernmost capital. At the same time last year, dwelling values across Perth had risen by only 1.1% over the 12-month period. Even though dwelling values are surging higher, the number of sales across Hobart is actually lower during 2017 than it was over the same 4-month period of 2016. The lower number of settled sales probably can't be attributed to a lack of buyer demand. If so, we wouldn't be seeing such strong capital gains. Lower sales are more likely due to a shortage of advertised stock. Hobart listing numbers are currently tracking almost 30% lower than they were a year ago. Dwelling values actually edged 0.5% higher over the month across Darwin. However, the trend clearly remains negative, with Darwin dwelling values 2.6% lower over the first 4 months of the year. Similar to Perth, the number of settled sales has shown some evidence that buyer demand is rising across Darwin. Sales activity was 25% higher over the first 4 months of 2017 compared with the same period in 2016. While sales have moved off a low base, if buyer demand continues to trend higher, it may have a positive effect on the currently weak performance of dwelling values in the city. The Canberra housing market posted a surprise 2.8% fall in dwelling values over the month of April. However, the trend in capital gains generally remains on an upswing across the nation's capital. The annual trend shows Canberra dwelling values are 8.4% higher over the past 12 months, and transaction numbers have picked up as well, rising by almost 4% over the first 4 months of the year compared with the same period in 2016. In summary, the Australian housing market is potentially moving through an inflection point caused by a range of factors. While it may be too early to call the peak in the market, the coming months will provide a clearer indication as to whether the slowdown we saw in April was the result of seasonal factors, or was it the start of a more sustained trend characterised by lower or even negative rates of capital gain? The factors contributing to weaker growth include worsening housing affordability, rising mortgage rates, and tighter lending policies from APRA, as well as lenders. On the housing affordability front, CoreLogic's latest indicators show housing affordability based on a dwelling price to income ratio has never been this tough. Using December data, the national measure shows the median dwelling price is now 7.2 times higher than the median annual gross household income, ranging from a ratio of 8.4 times in Sydney to 4.5 times in Darwin. Alternatively, mortgage serviceability measures aren't quite as challenging thanks to the very low mortgage rate setting. The typical Australian household is dedicating 30.5% of their annual gross household income to service an 80% loan-to-valuation ratio mortgage. This measure was substantially higher in 2008, prior to interest rates falling. At this time, the same serviceability measures showed households needed to dedicate 51% of their gross annual household income to service a mortgage. These two contrasting methods for measuring affordability highlight that one of the biggest hurdles for housing affordability is simply getting your foot in the door. The deposit hurdles become an almost insurmountable challenge for some buyers due to the fact that incomes have risen at a far lower rate than housing prices. Add to that the costs of purchasing, such as stamp duty, conveyancing and inspections, and it becomes clear why first-time buyers are such a small component of the marketplace in regions like Sydney. Despite a stable cash rate since the latest cut in August last year, mortgage rates have been nudging higher. Investor rates are 25 basis points higher on variable loans and they're 30 basis points higher on fixed-rate loans. Higher mortgage rates coupled with rental yields around record low levels and strict servicing criteria from lenders is a recipe to slow down investment demand. Add to this the latest round of APRA regulation, which will make it harder to secure an interest-only loan and probably place further upwards pressure on mortgage rates, and it's looking more likely that the housing market will be slowing further over the coming months. The next few months will make for interesting analysis. If you're interested in tracking the housing market's performance in more detail, check out our wide range of research products and tools at www.corelogic.com.au.